Have you ever wondered how, billions of dollars can just vanish into thin air, seemingly overnight? Or how the absolute smartest investors in the room still manage to get taken for a ride? Today, we're popping the hood on the exact mechanics behind some of the biggest financial illusions ever orchestrated. Hello, everyone. Welcome to the Capital Intelligence Channel. We know that as serious investors, you aren't just here looking for the next hot stock pick. You're looking to protect your hard-earned capital. So in this explainer, we're delivering high-value insights by unpacking the actual plumbing behind historical and modern market manipulations. The goal? To arm you with actionable red flags for your own due diligence. Let's get into it. Here's the roadmap for today. Number 1, the mechanics of deception. 2, hoaxes and market pools. 3, accounting fraud and insiders. 4, the anatomy of Ponzi schemes. 5, the regulatory arms race. And finally, number 6, we'll wrap up with a solid checklist of red flags for smart investors. Starting off with Section 1, the mechanics of deception. To really bulletproof our portfolios, we've got to start by understanding the baseline plumbing of these frauds. What are we actually up against here? Well, market manipulation is basically the deliberate interference with the natural forces of supply and demand. The end goal is always the same: deceive investors and create an artificial price. And you know what's really fascinating? The technology we use to trade evolves at lightning speed, but the underlying human psychology and that mechanical intent to just distort free markets, that stays remarkably constant. It's always about creating an illusion. History paints a pretty incredible picture of this. Back in 1814, fraudsters were literally using physical disguises and semaphore telegraphs to spread fake news about Napoleon's death just to pump up British government bonds. Crazy, right? Fast forward to 1929, and you've got organized investment pools manipulating RCA stock using the new ticker tape. By 2008, Bernie Madoff is faking digital account statements. And then in 2010, the flash crash. A single trader used high-frequency spoofing algorithms to temporarily erase $1 trillion in market value. $1 trillion. The vehicle's completely changed, but the exploitation of human psychology doesn't change a bit. Moving on to Section 2, hoaxes and market pools. Let's dig into our first major category of deception, basically creating fake news to drive up prices. This is your classic pump and dump pattern. It was huge with the notorious investment pools of the 1920s, and it relies on 3 basic steps. First, a syndicate quietly scoops up cheap stock in a struggling company. Step 2, they spread completely false, overly positive news to create this massive illusion of demand. Back in the 20s, they'd literally trade the stock back and forth among themselves to artificially juice the price on the ticker tape. Then, step 3, as retail investors rush in because of the FOMO, the insiders dump their inflated shares. The public is left holding the bag when the price inevitably crashes. If we compare methods across a century, a really cool pattern pops up. The 1814 Napoleon hoax relied on disguises and the telegraph. The 1920s RCA pool used coordinated buying in the ticker tape. Notice how the tech shifts from the telegraph to the ticker, but the core behavior? Totally identical. They are mimicking informed trading to trap unsuspecting capital. Retail investors just assumed, hey, rising prices mean the insiders know something good. Let's hit Section 3, accounting fraud and insiders. So what happens when the deception isn't some rumor on the street, but it's actually coming from inside the house? Looking at 2 of the most devastating corporate accounting frauds in history shows us some very different mechanics. Enron used these crazy complex off-balance sheet entities to hide massive debts. That ended up wiping out $74 billion in shareholder value. WorldCom, though, they did something so incredibly simple it's almost brazen. They just capitalized normal, everyday operating expenses to hide an $11 billion error. Both led to total bankruptcy, and both resulted in the sweeping Sarbanes-Oxley Act, which forced executives to actually put their name on the line and personally certify financial statements. And then we have direct insider exploitation. In the 1980s, Ivan Boesky illegally made over $200 million trading on confidential M&A tips. Or take Albert H. Wiggin. During the 1929 crash, this guy was the head of Chase National Bank, and he secretly shorted 40,000 shares of his own company. He pocketed $4 million legally while the public got crushed. Over in India, the Satyam scandal had executives literally fabricating bank statements to inflate cash balances. The big takeaway here is that insiders hold a really dangerous informational advantage. When corporate governance fails, your capital is on the line. Section 4, the anatomy of Ponzi schemes. Next up, we are examining the most notorious form of fraud out there, the manipulation of market perception itself. $65 billion. That staggering number represents the estimated losses from Bernie Madoff's multi-decade Ponzi scheme. It's still the largest, most devastating financial fraud ever pulled off by a single individual in human history. And 150 years. That's the prison sentence Madoff got for it. The guy didn't just tell a few lies. He spent decades literally fabricating thousands of account statements to show his clients steady, completely fake profits. How did he do it? By weaponizing market psychology. The illusion he sold was all about exclusive access and these steady, low-volatility returns that totally defied normal market gravity. But the reality? It was a textbook Ponzi. He was just taking new investor money to pay out the older investors who wanted to withdraw. This whole house of cards dodged the regulators for years, right up until the 2008 financial crisis triggered a massive wave of redemptions that he just couldn't cover. Section 5. The regulatory arms race. With all of this going on, how in the world have authorities responded to these threats? Well, as a working paper from Lewis SCP on the recent Wirecard scandal points out, regulation is far from perfect. In the Wirecard case, BaFin, the German financial regulator, actually failed to detect a massive multi-billion-euro fraud. Why did they miss it? The paper argues it boils down to home country bias. Basically, instead of rigorously investigating the hard allegations brought up by the press and short sellers, the regulators' first instinct was to shield what they viewed as a domestic corporate champion. So what we see is that the regulatory landscape is fundamentally reactive. It builds up over time. The SEC was formed in 1934, only after the total devastation of the '29 crash. Sarbanes-Oxley came in 2002, but only after Enron and WorldCom blew up. And regulators only really started chasing algorithmic spoofing in the 2010s after the flash crash happened. They're constantly iterating, literally just trying to catch up to the latest tech upgrade of the exact same ancient deceptive behaviors. Finally, Section 6, red flags for smart investors. Look, if regulators are inherently reactive, how do we proactively protect our capital right now, using the data we've unpacked in this explainer?
Well, these specific metrics are going to be your absolute first line of defense. A normal market range might see daily price movements of around plus or minus 5%, maybe with volume bumping up to 150%. But look at the suspicious levels. If you see a stock's price jump more than 20% with absolutely no material news catalyst, and trading volumes are suddenly spiking 300% or more above average, your alarm bells should be ringing loudly. You are very likely looking at a manipulation pattern, maybe a modern pump and dump or a wash trading scheme.
And to add to those metrics, you'll want to keep this red flag checklist handy. First, watch out for order book spoofing. That's when massive buy or sell orders suddenly appear, making it look like there's huge momentum. And then boom, they vanish instantly before executing. Second, pay close attention to vague company announcements that promise the world but never actually show real progress. And most critically, watch the insiders. If a company is surviving on aggressive social media hype to pump its stock, while the executives are quietly delaying their filings or clustering their stock sales, run for the hills. Which brings us to our final thought. As we've seen today, history absolutely proves that the vehicles of fraud change. We've gone from semaphore telegraphs to high-frequency algorithms. But human greed, that never changes. The tactics just get a shiny new digital upgrade. So I leave you with this question. Does your current due diligence strategy actively screen for the hidden mechanics of market deception? Are you actually prepared to spot the next illusion before it traps your capital? Keep these red flags in mind, stay vigilant out there, and never stop questioning the consensus.